Hi there, I'm here to introduce you Capital Appreciation Point from Crystal Clear Indicator. It is a must-have for hardworking individuals. Prior to going to the detail of presentation, I need to go over the disclaimer. Traffic light and capital appreciation point are the results of proprietary risk analysis models and should be used as a part of your due diligence process. Crystal Clear Indicator is not a licensed financial advisor. Investing involves risk. Here are the contents of Capital Appreciation Point service. It provides real-time assessment on S&P 500, alerting potential entry points. It provides you a capital allocation tool, assisting your decision on how much to invest at each entry point. Using CAP has achieved 50% more return on equity than the biweekly investing in S&P 500 from 2009 to 2014. Return on equity of investing biweekly in S&P 500 is 45%. Return on equity using investing CAP is 62 to 71%. Here is a graph of S&P 500 from 2009 to 2014. SPY is an ETF, exchange traded fund that mimics S&P 500. Each pink triangle you see here is a entry point by using a biweekly plan, a typical 401k investment style. The average cost is represented by the pink line. It's about 142. In this period, the return using biweekly approach is about 45% as shown here. You take the closing price of 2014 divided by the average cost line. This piece of information is particularly important and serves as a reference case. If your portfolio has not generated 45% return in the same period, it is relevant to ask why. Are you satisfied with your return knowing that the reference case is 45%? In the next slide, I will show you a way to outperform the reference case, simply by adjusting the timing at the exchange. Using the same amount of money, different allocation and timing, the hypothetical return is 62% or higher depending on the choice of allocation plan. As you can see that each circle is a buy entry point provided by the proprietary model, and as you can see the average cost line is 127. It's much lower than the 145. As a result, the return on equity is 62% excluding dividends. Here is an overlap view to show the average cost of biweekly approach and the Crystal Clear Indicator CAP approach. As you can see, the green line is significantly lower than the pink line, and the CAP only show up when the long-term reward and risk ratio justify. Not like the biweekly, it shows up every, I'll say, 2 weeks. I have talked about the timing of using CAP. Now, in the next few slides, I will discuss the exchange plan to go along with the CAP. Here are some CAP samples. You have to understand what CAP is prior to going to the plan. So, CAP occurrences is uncertainty and cannot be forecasted. Capital appreciation point represented by day 1, 2, 3, orange cells here, 4, 5. In this particular table, it's all the way up to 11. It is an indication that current price has a good long-term reward and risk ratio. It is not the short-term bottom indicator, but there are times they both happen at the same time. In 2014, showed the example here, day 1 occur four times independently. Day 2 and day 3 occur twice independently. When I say independently, I mean they are not, I'll say, happen in a separate occasions. And below is a zoom in on day 4, 5, 6, occurrence in October 2014. Day 6 means that the 6 consecutive days that meets cap criteria. When the market does not meet the criteria, the cap resets. So in this particular example, let's just assume that day 9, October 19th is another meet the criteria again. Then October 19th will be considered day 1 and not day 7 or 8 in this case. Here is a close-up on day 1 that happened on December 16th, 2014. In this particular example, day 1 is also a short-term bottom indicator, as is shown here, because it bounced back right away after day 1 occurred. It bounced about, I'll say, 5, 6, 7%. This is not always the case, as I will show you in the next slide. Here is an example of day 6 back in October 17, 2014. Day 1 started on October 10th and continue to day 2, October 13th, day 3, October 14th, day 4, day 5, day 6. SP500 meet the criteria until day 6 on October 17th. In the next slide, I will show you a tool to capture this type of opportunities. A location plane tool can help you to identify the amount of exchange when cap occurs. This tool is available at crystalclearindicator.com. Day 1, day 2 to day 11 are represented by the orange cells. They are the capital appreciation points. Occurrences represent historical cap, I'll say, occurrences. It's right over here. It has the years from 2014 to 2009. Yellow cells here are for users input to establish the desired exchange amount when cap occurs. I'll go into details how to use the tool in the next slide. So here are the steps to develop a plan. Set aside the amount of money you want to invest. Second, what's the allocation amount when each cap occurs? Do you start with 50, then go up to 100 and 200 and so forth? And what do you think the frequency will occur, knowing that what has happened? It doesn't have to be 100% correct, but this is a tool for you to visualize, using what you know, what will it look like for you, and what will it look like in different year scenario, which you can manipulate right here. Select a reference year. I'll show you an example right now. Hello. Here's the tool sheet itself, spreadsheet itself. And here at the bottom of the sheet, here's I'll say information for you. The representation showing that 62% return is basically based on this allocation right here. It basically, in this particular example, it nearly doubles every time cap occurs. And for me, for this time, I will set the frequency to be 1. I think it will only happen once for each occurrences. And the allocation method, I just leave it to default. And for the amount I want to invest, I put $18,500. So in this scenario, for each cap occurs, day 1 occurs, I will put $430. For day 2 occur, I'll put down $860, basically doubles. Okay. So under this scenario, In 2014, I will nearly use up all the amount of money I planned, which is the way it's supposed to be. If there's leftovers, you can always invest in the next cap. If there's one used up earlier, then you don't invest that year, which is fine. And if you want to see how other years impact your allocation, you can simply toggle the field right here. If you change to 2013, your allocation will be higher. You'll actually allocate $1,400 on day one. Day two, you'll be allocating $2,800. So how you allocate your money is really, I'll say, up to you. And you can see if 2011, the allocation will be lower because the frequency happened higher. But no matter what you selected, for that particular year, you're using up the amount and what you plan, okay, for this particular tool. So you can visualize that how much money you need to, I'll say, exchange each time that happens. And of course, Crystal Clear will provide some information on whether the current situation is similar to which year. So you can, I'll say, adjust accordingly. Here's a summary of CAP services. Crystal Clear Indicator offers capital appreciation point, CAP, on S&P 500 and others, ETF. It is an entry signal. It's a great supplement to traffic light and to be used when traffic light is in green, yellow, orange, and purple. From 2009 to 2014, the return on equity of biweekly, a typical 401k investment approach, is 45%. The return of equity of CAP is 62 to 75%, just changing the timing and the allocation. From another perspective, if the earning is $45 from biweekly, your earning could be $62 to $71 using CAP. The graph on the right demonstrates the lower average cost achieved by using CAP versus biweekly. Check out the current promotion at crystalclearindicator.com. A good entry system needs to supplement with an excellent exit strategy. With traffic light, an individual could identify the exit and entry point to avoid the market correction to 2000 and 2000 events. Look at it. When the crystal clear indicators exceed the red lines, that's the time to exit. And when you hit the purple line, that's the time to re-entry. It did that clearly for 2000 events, tell you when to get out, approximately here, and when you get back in, particularly here or here. Okay, there's an uptrend right there, an uptrend right there. That's another 100%. And for 2009 event, you identify the same thing. Okay. Hypothetical investing using the traffic light deliver gains of 200% above the market indexes, because you basically you exit and avoid the market correction. And with CAP services and traffic light, imagine what you can do with that competitive edge. Subscribe to Traffic Light at crystalclearindicator.com. Thank you for your time.